Good afternoon, everyone. This is Kim Schmidt. I am the executive editor of Farm Equipment Magazine. Welcome to our latest webinar, Tariffs and Taxes. We got what we wanted, now what? In conjunction with Pinion. Once again, we've got Mark Johnson from Pinion with us. Mark's the principal and lead advisor for Pinion's agriculture and construction equipment dealership segment. With that, we are ready to get started. Thanks again for joining us, and you can take it away, Mark.
Great, thanks, Kim. Well, the first thing I have to say is that the title, while I think I might have typed that up a long time ago, my marketing group might have had something to do with it as well, because that's probably why a lot of you joined. Tariffs and taxes, we got what we wanted. Now what? I'm not sure the tariffs are what we wanted, but I'll get into a little later why actually they're an important part of this whole thing. But as all of you are aware, we are heading into 2025. Knowing that there was a cliff at the end of this that was going to result in a bunch of bad taxes. And so a lot of us were asking for a lot of stuff to happen tax-wise. And so to say if we got what we wanted or not, we did ask for a lot of stuff. So, it made me think of a couple of songs here, especially as our president likes to dance a lot. And I know he likes to dance to the YMCA song, but it made me think of the Spice Girls are always telling us, so tell me what you want, what you really, really want. I think we did get a lot of that. And then the Rolling Stones remind us that you can't always get what you want. And while we did get what we want, there are some repercussions, I think, to this tax bill that at some point might come up and sneak up on us. So I thought that was kind of appropriate to share a couple of famous song lyrics there. So as we get into today, what I'd like to kind of focus on is, taxes and tariffs and everything. We got what we wanted, or did we? What exactly did we get? I'm sure some of you have been to a lot of different webinars or presentations over the course of this year. I know I've given several about what this bill is. I'm going to assume for a little bit that some of you haven't heard anything. So there's part of this that we're just going to go through and say, hey, what did we get? And so we know what has changed and what hasn't. And then at the end of this, I'd like to get into, are there things that your dealership to do to respond to this? And more importantly, how is your customer going to respond? So if you're familiar with Pinion, you'll know that most of our customers outside of my world in our firm are agriculture producers. And so our customers are kind of the same customers as yours. So we're hearing what they wanted and what they need and how they're going to respond to this kind of thing. And so I'll share a little bit about that. Where are your opportunities? And then what's next? I listed some quick facts up there, and I'm not going to read through those. But the thing to take from that is it was a big bill, lots of pages, lots of stuff to figure out later in the midst of now a government shutdown. And this thing was tied at the lowest of margins possible. One vote plus the vice president breaking a tie. And so there's a lot in here that you'll see that some of it was kind of a little funky, I'd say, and others of it is exactly what we asked for. And like I said, there's going to be some repercussions for it later. So with that, we'll dive into it. As a reminder, this bill isn't a whole lot different than the ginormous bill that was passed back in 2018. And that was the Tax Cuts and Jobs Act bill of 2018. And if you have any accounting background at all, you would know that it was the biggest tax bill that had passed since 1986. So when we look at how many things were changed and everything that was in that bill, it was humongous. The only way we could get it to pay for itself, because we passed that one under reconciliation as well, which reconciliation just means if we've got one party that's in control of everything in DC at the moment, the presidency and both houses of Congress, and they can pass it with a very slim margin. As long as the House and the Senate kind of agree, they pass it on a very slim margin. But most of it cannot be permanent. It has to kind of be revenue neutral in order for it to be permanent. Well, they didn't get it revenue neutral in 2018. And so what happened was here at the end of 2025, most of the good stuff of that bill was going to fall off. So we were worried about our estate tax. We were worried about tax rates. We were worried about bonus depreciation. And so if you had talked to your accountant at all in the last 18 months, they probably painted a fairly bleak picture for you on what your future tax burdens could look like. And it was true. But then the one big beautiful bill passed, or got rumors of passing, and then it did pass on the end of June, and the president signed it on July 4th. Pretty dramatic fashion there on July 4th, and our tax independence day. And in fact, there's a lot of stuff that you'll read now that says since our tax independence day, this is what has happened. And so that's what it's referring to, is that's when the one big beautiful bill passed. I would say that there's things in this bill that tend to be very good for us, but also could come back, and because the one side of the aisle wanted this so bad this way, I'm a little bit fearful for what happens the next time the other side of the aisle has control of everything, and what they might pass under a reconciliation bill. But for now, we're not going to worry about that. You got, as a dealer, you're fighting through the sludge of 2025 anyway. Particularly if you're an ag equipment dealer. My construction dealers are still faring pretty well, but my ag dealers, it is a tough road right now for all of you. And so a lot of what you'll see in this bill, you're probably wondering to yourself, well, that'll be great when I make money again. But right now, what does a tax bill even mean as I sludge through this? So I want to address that a little bit today when we get into it. So with that, we'll just kind of go line by line real quick on the stuff that I think matters to dealers. And the first thing is the raises the estate tax exemption. As you know, back in 2018, this raised to about $25 million for a married couple, and it raised for inflation every year, and life was good, right? Most people would not have an estate tax. Most of your farmers, your clients, would not have an estate tax bill at $26 million. And so we weren't too worried about it. And so a lot of things happened during that time. Farmers might have even given away a lot of their farm to their kids, thinking, hey, we might not get to keep this $26 million exemption, so let's do some serious estate planning while we have the opportunity. Because what was supposed to happen was in 2026, that number was going to go down to about $6 or $7 million per person. And so what would have not been a taxable estate now would have been a taxable estate. We don't have to worry about that, though. This you'll notice that this one is permanently. And I've tried to, in this presentation, refer to what's permanent and what's not. The reason we were able to get permanent, that's the only good part about tariffs, right? So as we got to the end of this bill, it was still about depending on who scored the bill or who kind of did the economic background of it, it was somewhere between $3 and $8 billion or $8 trillion in the hole, right? Which meant we can't pass it. Or we can't do anything permanently. And so basically it would have been another 2018 type tax act that would have got enacted in 2025, and about 2030, all the good stuff would have fallen off. Well, luckily, or not luckily, it depends on how long it lasts. We had the tariff thing as well. And so that was why you saw the tariffs come and go, and we had 90-day holds, and we had, this was going to take effect at this time and whatnot. Well, most of that did take effect July 9th, which was right after this July 4th tax bill. And so that basically got us to a little bit closer to revenue neutral than we would have otherwise been. So that helped this bill get a lot of stuff permanent on here. And the estate tax exemption is one of them. So not only did we get permanent estate tax exemption up to $26 million, there was also rumor that step-up basis was going to go away, and it did not. So we still have step-up basis, and we still have a high exemption on the estate tax. So for the most part, this shouldn't impact us. Our fear was we would have farms, we would have big businesses, trade hands with low basis, and then we'd have a tax bill right after somebody died that would basically gobble up all the value of a company or a farm, and that's not the case. So this is that we can breathe a breath of fresh air. As a reminder, what permanently means just is that it's permanent until Congress changes it. So it doesn't fall off automatically. It doesn't sunset like the things we're going to have to happen this year, but it's permanent until Congress changes it. So right now that looks to be, Congress isn't going to be able to change anything against this until another party at least has control of one of the houses or both the houses. And so we're permanent through at least the next election, I guess is what we'd word that. But it does take an act of Congress, something to go through the process, pass, and have the president sign it in order to change any of the stuff that I refer to as permanent. The other thing then that was permanent was the restoration of the 100% bonus depreciation. So effective January 20th, essentially, it's the inauguration day, one of the little gimmicky things. So inauguration day this year, once President Trump took office, we retroactively approved bonus depreciation back to 100%. And it was otherwise going to be 40% this year. Meaning if you bought a piece of equipment worth $100,000, instead of being able to write $100,000 off of your tax bill, you could only write off $40,000 and then carry the rest and write it off over the next 5 years. Well, this changes that, goes back retroactive to January 20th. And the thing one of the things I always want to make sure I tell dealers is, as we get to the end of the year and farmers might have bought something from you in early January, prior to January 19th, and they're doing their tax planning at the end of this year, and their accountant says, hey, you need to write this off. And they say, I bought it January 10th. They might be coming into your dealership and saying, hey, we need a new invoice that says January 20th or January 21st instead of January 10th. As a dealer, I would encourage you not to do that. We don't want to fake an invoice and send something out, and instead remind the farmer that it's acquired and placed in service. So the placed in service part is the part that's important. They put that in service after January 20th because most places in the country, it was cold and it was dark and damp, and they weren't using that equipment until after January 20th anyway. So that shouldn't be a big deal. But again, as a dealer, I would encourage you, don't fake invoices just to help a farmer out with this. Remind them instead that it's placed in service. The other thing that I'd say that passed on this bonus depreciation is especially for your farm clients, there was a temporary deduction out there for bonus depreciation allowed on some ag production facilities. So if they put up some production facilities, those could also be bonus at 100%. That doesn't really matter to you other than anytime a farmer can get more deduction, that's more cash in their pocket and less tax that they paid and better off for you. Section 179 was also raised. And it went to basically $2.5 million as long as they didn't spend more than $4 million. One of the things my dealers get confused on a whole lot is the difference between bonus depreciation and Section 179. Effectively, it does the same thing. A farmer buys $100,000 worth of stuff, and under either scenario, he can write off $100,000. The limitation becomes on if they buy more than, it was $2.5 million, but now it's $4 million. If they buy more than $4 million worth of stuff, they couldn't use 179 this year. Now, if they buy less than $4 million, they can. The other difference is bonus depreciation looks at depreciation classes, and it says equipment is 5 years and leasehold improvements are 10 or 15 years. It's got all these different these lives that they depreciate things over. And essentially, bonus depreciation is good for any asset that's less than essentially the 15-year lifetime or the life term. But when you elect bonus depreciation, you don't elect it asset by asset by asset. You elect it by class life. So if you bought $2 million worth of tractors under a multi-unit discount deal, you elected bonus depreciation on one of them, you elected on all of them. So you can't just write off one tractor at $100,000. You have to recognize all those tractors and write off the whole $2.5 million. And sometimes that puts a farmer's balance sheet, in a problem area, right? Like that their bank, because they're going to have a loss, and their bank's going to look at that and think of them different. Same with you guys. This isn't just farmers. I just talk about farmers because that's important to you guys as our customers, but to you guys as well. If you buy stuff, typically you're buying more than $4 million worth of stuff during a year, so you can't use Section 179. So bonus depreciation is important to you. But again, if you elect bonus depreciation, it's everything within that class life. So it winds up with a bigger deduction. Another piece that we were really after was R&D expensing restored. So one of the things that the 2018 Tax Act did was it allowed for a big R&D credit. But what it did was it said anything that you purchased that led to the creation of that credit, you had to capitalize now versus expense. And so most people weren't able to take the R&D credit to the extent they wanted to. So the purpose of the law wasn't fulfilled in getting people to do research and development because people didn't want to capitalize those expenses that they otherwise wouldn't have had to capitalize. And so what the big beautiful bill did was it restored the fact that we can expense the expenses that led up to the creation of the credit and then take the credit. So it really, again, most of my dealers don't have anything in their stuff that allows them an R&D credit because it's about creating things that create improvements or create something new. And dealers typically are selling equipment to other people that might be doing that. So it does hopefully, again, free up some cash for your customers to help them buy more stuff. Another thing that did, and this is very important for both dealers and your customers, and that is the Section 199A QBI deduction, which is essentially means that the first 20% of your profit doesn't get taxed, which is a pretty big deal. That was going to go away both for farmers and you guys, and that stays, and that is permanent. And so that will not go away. And so otherwise that would have been a pretty big tax increase because that 20% would have become taxable. So that's a big deal for you and your customers. Then finally, depending on what state you are, this is a bigger deal than some others, but that's the state and local tax deduction, or the SALT deduction as we call it. For those of you who hadn't paid attention, since 2018, the most anybody could put on their individual tax return for a tax deduction when they itemized was $10,000. That included their income tax bill to their states, their property taxes, their real estate taxes, anything they paid to the state. That added up. You could only take $10,000, and anything over that $10,000 was essentially not deductible. It didn't carry over. It was just gone. We came up in the accounting industry, came up with a workaround for that a couple of years ago that you guys have probably implemented, called the pass-through entity tax deduction. And what that allowed you to do was, if you were a pass-through entity, an S corp or a partnership, you could essentially pay your partner's tax bill through the company. And if you made $100,000 and you owed $5,000 in state taxes, the company now made $100,000 less $5,000, so only distributed out $95,000. So you essentially got all of your taxes, your income taxes for the company as a separate deduction that didn't count towards your $10,000. So what happened in this was they raised it to $40,000. So that's a big deal. It goes from 10 to 40. But they also preserved the pass-through entity tax deduction. So those of you that have already done the pass-through entity tax deduction, you should continue doing it. Because that'll allow you to get, your income tax for your dealership when you're making money again, to be deducted at the dealership level. And then you're still allowed $40,000 of a deduction on your personal return. And $40,000 doesn't go that far depending on what state you live in as far as income taxes and then your real estate taxes. So this is a good deduction to have, and it kind of makes the playing ground a little bit more fair. Okay, so interest limitations. Now, this doesn't matter when you don't have any EBITDA. But one of the things that happened a couple of years ago was that when we started calculating the amount of interest that you paid as a dealership towards what we could deduct, we had to look at that as a percentage of your EBITDA. 2 years ago, that changed to take out the depreciation part of that. So again, we'd look at your net income, we'd add back interest, taxes, depreciation, and amortization. Before the last 2 years, we didn't get to add back depreciation and amortization. So the number that we were calculating as a percent of that was a lot smaller. So most of you probably had your interest deduction limited. It didn't mean you lost it like in the SALT, but if you had, if your interest deduction exceeded the 30% of your income, of your adjusted EBIT, then you didn't get to take it that year and you had to carry it over to the next year. And then that number had to factor into the 30% of the next year, and so on and so on and so on until you got it all used. So getting this back to EBITDA should get most of you a full deduction for your interest, because before they took that away a couple of years ago, as I looked over our dealership group, most of our dealers had a full interest deduction and didn't get it limited. It just happened when we took away depreciation. So that's good. Capital gain allowances. This is one that I've given this some version of a webinar like this several times now. I guess if I had more farmers as clients instead of dealerships as clients, I'd probably understand this one a little bit more. But this almost feels like a little bit of a gimme to the farmers. And basically, if a qualified farm land was sold to a qualified farmer, which the qualified essentially just mean the farm was actually a farm and not something else. It was, it was producing a crop or something, and it was sold to a farmer, somebody that actually was performing the work of farming, then that capital gain that was resulted from the sale of that qualified land, you get to spread the tax out over 4 years instead of paying it all at once. Again, I'm not sure I understand the point of this, particularly if all the cash was received in the first year. But if all the cash was received in the first year and the farmer only had to pay a third of the tax or a fourth of the tax, then that meant that he has more money in his pocket this year to buy stuff from you. So from that standpoint, I'm glad that they did it. This 1202 allowance is something that has been out there forever. So first off, if you're not a C corporation, you don't need to pay too much attention to this because it doesn't matter to you. But if you're a C corporation, one of the things that's always problematic is when, as a C corporation grows in value, it's very expensive to sell out of it. We pay the tax all along, and then we sell, and there's a capital gain on that. And so when we sell the company, we pay tax again. And that's the whole notion of double taxation. There's always been this notion of Section 1202. It's been around for a long time. It's gone through several different variations. But the latest variation is if you own stock in a qualified 1202 company, and I'll get back to that, what that is in a second, and you hold that stock for more than 5 years, that gain can actually be completely excluded. I'll say that most of you on the phone probably don't have that qualification right now, but going through succession planning as you maybe sell some stock to your next generation, you should try very hard to make sure it does qualify as 1202. It's a little bit complicated, so you'll need to talk to your accountant to do it, but essentially it means you got to buy original stock from the company. It can't be new stock that the company just issues for the purpose of qualifying as 1202. But if it's original stock and you hold it long enough, you can literally get out of a C Corp after that 5-year holding period and eliminate the tax on it. So again, some of you guys, your stock is old, you've had it a while, it doesn't count. But as you look towards succession planning and maybe turning over some stock to the next generation or to some employees or something like that, talk to your accountant about how 1202 might help you save a lot of tax in the future on that. Tax rates. So now we get to the individual side. Tax rates are exactly the same in 2026 as they are in 2025, and they will be that way until Congress passes something different. So we don't have to worry about the 39.6% rate. We don't have to worry about a new millionaire or billionaire tax that they rumored. The tax rates are exactly the same. As you can see here, they range from 10% up to 37%, depending on how much money you made. And you get the benefit of every one of those brackets, and so that's a good thing. What will continue to change every year, like it always has, is the brackets themselves are subject to inflation. So the 10% rate it will grow, the 12% rate, and every one of those should grow and more of it qualified every year in each one of those brackets. So that's a great thing. We don't have to worry about a higher tax rate as we look at going forward. It makes tax planning very difficult to do when you're not sure what the next year's tax rates are going to do. So the last thing you want to do is do a bunch of tax planning this year to save because you're in the 24% rate, only to find out that next year what you thought was going to be a 24% rate is a 27% rate, and you might have done some things a little bit differently had you known that. So having a permanent tax rate is very important to do effective tax planning. Standard deduction is one that you might not have even, depending on what your tax return looks like. We actually, the standard deduction went up really high several years ago in 2018 when essentially everybody's biggest deduction, being state and local taxes, got limited to $10,000. So what they did was they raised the standard deduction, but it was going to go back to its old version next year. So the standard deduction is going to stay high. You can see here for married filing jointly people, that's $31,500 next year. And for most taxpayers, $31,500 is probably more than they pay for their itemized deductions. So itemized deductions are generally, for most people, they don't get their medical because it's usually lower than what than what the minimum is for them. They get their estate tax, they get their mortgage interest, they get their charitable donations, and those are kind of the big three. And a lot of people don't spend $31,500 combined on those. So a lot of people take this standard deduction. Well, that was going to go back down to like under $10,000 next year, and that would have been difficult for people to swallow, particularly on the low side of the income spectrum. So that's good that stayed at 31.5. I already addressed this, that it's $40,000. That $40,000 does adjust for inflation by 1% a year, but this one was not permanent. This one probably was not permanent, not because they couldn't make it permanent because of the income restriction, but more, this is one that keeps, this one is what keeps the states up at night, so to speak, in Washington, D.C., when we have some states that have a 5% tax rate. We have some states that have a 0% tax rate. And we have some states that have a 12 to 14% tax rate. And so when their constituents are paying taxes at somewhere between 0 and 14%, and they may or may not get to deduct those, it makes those senators and congressmen from different states kind of have a pretty lively argument about what a SALT restriction should look like. And that's exactly why it's there. It's supposed to make it so that the government doesn't subsidize the state, and the state doesn't subsidize the government just through their tax rates. And so that's probably why this one reverts. But in 2030, it goes back down to $10,000. So enjoy the $40,000 while we have it. The other thing that permanently, because we have a permanent standard deduction that got higher and increases with inflation, we also had to then, the standard deduction was going to go back down. But part of that is because the personal exemption was going to come back in 2026, and neither one of them are going to do that now. So the standard deduction is going to stay high, and the personal exemption is still going to be 0. With the caveat is they added a new, what I'll call a senior deduction, and that one is a temporary one, and it is basically a $6,000 deduction for taxpayers over 65. One of the things that was rumored in this is we weren't going to pay tax on Social Security. And instead of doing that, what they did was they put this $6,000 deduction in. And for most people, that $6,000 will more than cover what would have been taxable for their Social Security. So it effectively got rid of tax on Social Security, but it just did it in a different way by giving this exemption. That one also is temporary, though. Child tax credits, those stayed around, and they actually got a little bit better. They went to $2,200 a child instead of $2,000 a child. So your employees will like this. Their tax rate, their tax will go down a little bit because of that. Charitable donations is a weird one. This one is still it's an itemized deduction. It's subject to, for most people, they can give away 60% of their income. Unless they're this is new, unless they're in the top tax bracket, then they can only give away up to 35% of their income. So the limitation isn't necessarily new. That 35% limit is new. One thing it did add, though, is it put a $1,000 per taxpayer above the line deduction out there for people that take the standard deduction. So if you're spent less than 31.5 earlier, and you're taking the standard deduction, the government thought it was still important to have a charitable donation incentive out there for people. So that there's $1,000, you can take 31.5 on your standard deduction, and if you donated $1,000, you can also get that out there. But it also put in a 0.5% floor. So if you make $100,000 and you donate less than $500, you don't get to deduct any of it. Until you only get to deduct from $5.501 and up. And so I'm not sure what the thinking behind that was, but it was probably something to do with the fact that they put this $1,000 above the line deduction in there, and this was a pay for. The other thing it did, which was strange, is C corporations have always had a 10% ceiling, but they put in a 1% floor as well. And so it got a little tighter for C corporations to to get their charitable donations in there, because they don't get to deduct the first percent. They only get to deduct 2% to 10%. Now, to the extent they donate more than 10%, and same with an individual, to the extent they donate more than 60% of their income, that does carry over to future years. Okay, and then there was a few miscellaneous provisions in there. One that's permanent, and it actually is on the bad side, is you're only allowed to deduct mortgage interest up to the amount that's interest on a $750,000 mortgage. That was going to go away at the end of 2025, and then instead that wound up being permanent. So if you've got $1 million mortgage, in theory, the 1098 that comes out from your bank is going to look a little bit different. It's probably going to say this is the interest on the first 750, and this is the interest on the rest of it. That's on qualified residence interest deduction. And I think what will happen on this is the banks are going to start pushing secondary loans and stuff like that might be more deductible. So we'll see what the banks do with that, but that is out there. And then a couple of them on there that you've heard in the news a lot is we heard that there was going to be no tax on tips and no tax on overtime. Not quite true the way it turned out. Both of these are a temporary deduction, and there's tax on tips and tax on overtime, but only after a certain point. So for tips, the first off, the cash tips that waiters and waitresses get paid, those are still up to them to report. So those are most likely not taxed or partially taxed at best. But the taxes that do get reported, they get the first $25,000 for free. And on overtime, the first $12,500 per person or $25,000 joint return is also free. Now, you might ask as an employer, gee whiz, I haven't looked at my W-2s. Do I need to be concerned about that? And the answer is no. So what's happening is withholding didn't change. So if your employees are getting overtime, you're still withholding like normal, or your payroll company is still withholding like normal. And when the employee files their tax return at the end of the year, there'll essentially be a credit back for their overtime tax. So the W-2 will add a couple of lines to report that right, but there won't be anything different that you need to do. Another one that's interesting for dealers is car loan interest has really never been deductible. They created a new deduction of up to $10,000 for interest paid for acquiring a vehicle that's final assembled in the U.S. It's a temporary deduction that only lasts through 2028. But one of the things that's interesting about it is the definition of that vehicle essentially is about anything with four wheels that was finished in the U.S. So if you're selling UTVs or ATVs out of your dealership for personal reasons, the ones that you were selling to a farm or a business, those were already the interest on that was already deductible. But if you're just selling somebody a Polaris or a gator or whatever you're selling them to go out and hunt with or whatever, that interest has never been deductible in the past. Now it is up to $10,000. So that's actually something that you could market, and I've seen a lot of dealers already marketing that, and that is true. If you've seen that, it is true. So the first $10,000 they do get to deduct. And then child and dependent care, those basically increased a little bit. And then there's a host of other stuff in here that I'm not going to talk about today. The pay-fors essentially came from the Inflation Reduction Act stuff and was mainly related to energy credits. So as far as being a dealership, what you need to be concerned about there is if you're thinking about doing a new project that was solar or whatever, you're probably already too late. If you had one in place, most likely you need to get it finished, that project over the finish line, in order to get the credits that you wanted for that, because otherwise those are going away. So I'm not going to speak to each one of those, but if you guys have got a project in place, you might want to talk to your tax preparer about, is it still going to, do you the good that you thought it was going to do? Because most of those credits went away. Okay. On the ag sector side, as most of you know, we haven't had a farm bill that's been really in place since 2018. And in fact, farm program payments for most of our farmers have just been decreasing. So much so that when you look at that as a percentage of farm cash income, it's gone. Basically, the only thing that's out there has been disaster payments. We got an extra $33 billion that flowed through the system in April that was approved last December. So that was already going to look better. But one of the things that this did was it added $66 billion of new spending for farm programs, essentially raised the acreage and raised the maximums and things like that. So we'll put $66 billion in the farmer's pocket, provided the government opens back up and has somebody to sign checks. So hopefully that happens soon. And then there's also some stuff in here about ethanol, which is it it preserves some ethanol. It took some of the ethanol credits away. But for the most part, our corn prices that are dependent on ethanol should still stay at least where they're at now, and hopefully won't go down too much more, at least not because of ethanol's. It won't be ethanol's fault. Okay, so a couple of cautions. First off, this big and beautiful bill is also big and complex. So there are a lot of changes, a lot of tax forms have to be changed, and the IRS is essentially currently closed. There's a few essential people there, but the people that are out there to write up how we interpret what this new tax law looks like on a tax form, I'm not sure they're working right now. So it could be a long tax season next year to get this to see what this is going to take place or how it's going to take place. The other thing is, like I said, there's some gimmicky stuff out there. I already talked about some of it. There's some other stuff out there too. It's an interesting read. You should go read it if you got time to look at the 870 pages. But there's things out there like Trump money and MAGA money and stuff like that are just interesting things to read. But the gimmicky part of that, I just don't like. I hope it doesn't come back to bite us later. There will be complexities with our W-2 and 1099s. One good thing about the 1099s is it lowered the limit or lowered the threshold. It used to be anybody that you gave more than $600 to, you had to give a 1099 to. Next year, that number, I think, goes to $2,500 in 2026. So you should have to at least do less 1099s. So that's good. If you've got some tax planning strategies, you probably need to dust them off. The good thing is this should be the last time you have to dust them off for a while, because everything that is important for your tax planning was pretty much permanent. So we hope that we don't want the IRS to get back to fully staffed where they're doing a lot of audits and things like that. But we would like to have them have enough staff to answer their phone and write the tax bills. And currently that's probably not the case. And then finally, how the states react to this. I have a slide here in a little bit to see that not all the states will enact a lot of this stuff, and I'll show you that. But how tariffs, how states, and how the IRS responds to all this is a little bit yet to be determined. So that's a caution of this new bill. Okay, so now a few things on what should dealerships do as far as planning goes. One of the things I'd like to point out, particularly for my ag dealers, is bonus depreciation in Section 179. They don't quite have the same impact on farmers now as they did before. I'm actually sitting in one of my first dealerships that I had as a client in their building today. I had a meeting with them this morning and asked them if I could borrow space to sit here. But it strikes me that back early in my career, when I worked on more than dealerships, I had some farmers in this town also, as well as this dealership, that this dealership gave me a lot of credit for selling tractors. And the reason they did was because if I went to a farmer and he had profit, it was really easy to get their tax bill down. I just told them to go buy a tractor from so-and-so up the street. And it literally, that was the formula that most farmers use. You guys know it. It's not the most healthy. It's not probably the best thing that they should do, but it's pretty much been their tax strategy, right? If the farm profit was $250,000, easy enough, buy a $250,000 tractor or a combine, and I got no tax on the farm. Now that formula is a little bit different because of the 199A that I talked about earlier, where the first 20% we don't pay tax on, but it's not really the first 20%, it's the last 20%. So if I make $250,000 on a farm, you start trying to do that math and it gets really confusing. Well, if I buy a $200,000 tractor, then I have a $50,000 profit left and I only get $10,000 free in tax. But if I would have bought a $150,000 tractor, then I would have got $20,000 free in tax. And so it leads to a little bit of confusion to them on how much 199A benefit do I want versus eating it all up by buying a tractor or a combine and maybe losing part of that so-called benefit. So the formula is just a little bit different. And if anything, even if that confusion doesn't get them, it does mean that they have to buy less to get their tax bill down as far as they wanted to. And so that's why I say it doesn't have quite the same impact to you as it did before. And then the other thing is that $250,000 today doesn't buy what it did back then, unless they're buying some of that stuff right now that you're just desperate to get rid of, and then it buys a whole lot. So hopefully you guys are almost, you're getting close to the bottom of that inventory bucket where you're desperate to get rid of it, but I know some of you aren't, so I don't need to make light of that, but we do got to get through this current inventory cycle we're in before we worry too much about that side. Okay, bonus depreciation also is not the same for every dealership. You can see here that most of the states, the green ones, they were already 100% bonus depreciation. So they were already out in front of the federal government. So this bonus depreciation change for them didn't matter. So if you were down south in Oklahoma, Louisiana, Mississippi, you're like, oh, well, I already had bonus depreciation. The rest of these states in yellow, they just follow what the federal says. So if the federal says we bonus depreciation at 100%, then that state says. The red ones, they don't accept it at all. Imagine that. Some of those states are pretty high tax states anyway, California, Minnesota particularly. They also don't allow bonus depreciation. So what happens is you calculate your depreciation for federal purposes. You calculate your depreciation for book purposes for your audit, and you're also calculating your depreciation a third way for your state. And so you've got some deferred taxes in all those situations that you got to keep track of. Just makes it a little bit more complicated. If your state tax rate is high enough, then that is kind of important to you that you didn't get it. And then we got some states that are hybrids or fractionals or ones that haven't decided what they're going to do yet. You see Texas, for instance. Well, Texas doesn't have an income tax, so I'm not sure it matters, but they haven't decided what they're going to do with 100% bonus depreciation yet. So more to be determined there. So if you're in one of those states that's not yellow or green, then definitely you should always be talking to your congressman about how you're treated, you're not treated fair with the other states, and you'd like to see some bonus depreciation for you and your customers as well. Okay, other things with dealership planning to think about. One of the things that the bill did that I haven't mentioned yet is it allowed for technician training to qualify for Pell Grants and 529s. So again, it might not affect you as much as it might help your future technicians pay for their technician training, because if they can get a Pell Grant where they didn't used to because the technician training wasn't long enough. And you didn't have enough hours, didn't have enough weeks long, and now they've really shortened that. So most technician training should count, as well as if their parents or their grandparents or whoever has put money in a 529 plan for them. That always talked about post-secondary credentialing, and now for the most part, any of the credentials for the technician training would also count. So if they go to technician training, they can use some of their parents or grandparents' money that they put in that 529 plan to help pay for it. So maybe you guys don't have to shoulder the complete burden of technician training like you have over the last couple of years. Okay, some other stuff with planning. Carry forwards still work for the most part, and I've put some of them on here because they become quite important. This year, like I said, a lot of you are probably thinking, man, I'm not even sure my dealership's going to make any money this year. We haven't yet. We haven't through August or September. Hopefully the back half of the year is going to produce some buying, which it does look like that's going to happen. But if you've lost a lot of money already year to date this year, i.e. you've given back some of the profits that you made in 2021 and 2022 and 2023, if you generate a loss this year, you don't lose those deductions. They carry over. They carry over forever too. There's no expiration date to them, but you can only use them against 80% of your future income. So let's say you lost $100,000 this year, and you make $100,000 next year. You don't just get to offset the whole $100,000 next year. You get to offset 80,000 of it, and you still have to pay tax next year on 20, and then you carry that other 20 to future years. So you don't lose any of it. You just don't get to use it all at once. Section 179, this is for you and your customers. If you buy more than what your income is, you can't take a loss with Section 179, but you can 179 the whole piece of equipment and then carry forward that deduction. You just can't create an NOL. So if you make $100,000 of profit, you buy a $150,000 machine, you can write off the $150,000, but $50,000 of that deduction is going to go towards next year, not this year. So that's important for your sales guys to understand. If a customer says, hey, I don't need a $150,000 deduction, I only need a $100,000 deduction, remind him, hey, it's better to take it now and you can carry it forward next year. That's that much less you'll have to buy next year. Bonus depreciation, there isn't a carry forward because you can't generate a loss. So I can only take bonus depreciation down to the point my income is zero. So you can't, but you can get it down to zero, and then the rest of your NOL can carry forward. Interest limitations. A lot of you, I'm sure this year in particular, are going to have an interest limitation, or you did last year. There are no expiration dates to those carry forwards of the interest that was over your limitation. But they are limited in the future to the same calculation that limited it in the past, which is generally 30%. So again, if you're carrying forward, $50,000 worth of interest deduction that you didn't get to take this year, you can only take that against 30% of your income in the following year, but it doesn't expire. You get to keep taking it until it disappears. Charitable contributions on the individual side or even on the pass-through side. So if you're an S corp or a partnership and it passes through to your individual owners on their K1, they're limited to 60% or 35%. And remember, if they're in the 37% tax bracket, those carry forward, but they do expire. You have 5 years to use them. And they are also subject to the same limitation that created the limitation to begin with. So you can never take more than 60% of your income or 35% of your income, regardless of whether it's a current charitable donation or a carryover charitable donation. And on the corporation side, same thing. The donation that's over the 10% expires in 5 years. The donations, interestingly, that are under the minimum, you never get to take. So that new minimum threshold is an interesting one, but you never get to take those this year or in the future. But the excess you can take in the future. Okay, another thing, dealerships planning. I'm not going to go into this because this slideshow will be made available to you. But essentially, if you looked at opportunity zones back from the 2018 Act, which is essentially if you put up a new building, in an area that's essentially low income neighborhood, you could kind of roll some property into that and take advantage of some capital gain deferrals. What happened with most of my dealers anyway, it seemed like every time we looked at this, the opportunity zone was about 1.5 blocks away from where we wanted to put our dealership building, and it didn't work. And so for the most part, what you'll see now is don't give up on it if you gave up on 2018, because the zones expanded. There's, especially on the rural side, there's a lot more rural area that can be qualified for that. So again, I'm not going to go into this a whole lot, but if you looked at it in the past and you think this might be something for you, it's worth looking at again, because I think the new definitions of the opportunity zones will mean that you can utilize this to your benefit in the dealership. Kim, I think this might be the first time ever that I have finished at 2:50 like you asked me to do. So I don't know how I did that. I just looked at my clock and it's 2:50 or 2:48, I guess. And I've never finished on time to allow for questions. So this will probably be the one time no one has any questions. But anyway, that's all I got.
I was going to say, we do currently have no questions. So if anyone does have any questions, feel free to use that Q&A field to type them in and I will get them asked. I guess anything to kind of touch on, at least briefly, as it relates to the tariff piece of things? I know you kind of addressed that.
Yeah, I mean, the tariff thing, I've been asked to talk about that before. And essentially the tariff to you guys is just a price increase, right? And there's not a whole lot you can do about it. Whatever the manufacturer decides to pass through to you, they're going to pass through. Unfortunately, that number keeps shifting on us a little bit, it feels like. And depending on where your equipment's manufactured and what color your equipment is, your tariff's bigger than some other dealers. So I think the one thing I've been telling people to just pay attention to is make sure, whether you show it to the customer or not, and I actually would encourage you to show it to the customer, to the extent there's tariffs involved in the stuff you're selling, you need to kind of track that, because 2 or 3 years from now, when they come to trade that equipment back in and, $5,000 or $10,000 or $15,000 of their price tag was a tariff, that doesn't mean that $5,000 or $10,000 or $15,000 that they paid now is worth anything when they trade that in, because it was a tax. It wasn't a value. It wasn't anything that you did. It wasn't anything that they got value for. It was a tax that our government said they had to pay because of where it was manufactured. And I don't want you guys to get stuck with, a customer thinking they deserve $15,000 more on their trade-in 2 years from now when they don't, because it was just a tax. That's about the only thing you can do. Otherwise, it's just a price increase that you're dealing with in a year that you can't afford any price increases. And so I think that's the only thing I have to say about. I sound like Forrest Gump. That's about all I got to say on that one, Kim. But that's really how I look at it. If anybody has something different, I'd love to have a conversation with you. But that's the way I see it right now.
Okay, we just got a couple tariff related questions. So we'll see if you got anything here. Do you see a tariff rebate in the future, especially when China tariff was near 150% for that brief time?
I think there'll be something. One of the things that Trump said earlier this week was and it doesn't have to do with the rebate on equipment, but it has to do with kind of making things fair. And that's with soybeans. The first thing that happened, I'm in Kansas today. Soybean mix here is really high. So when I look at farmer sentiment across the country, it's about as low as you get in Kansas because of the high soybean mix. That's for those of you who didn't pay attention. China basically said, because of these tariffs, we're not buying any U.S. soybeans. That's a whole lot of soybeans going nowhere right now. And so one of the things that Trump did say, I think it was this week, it might have been last week, but it was basically a 10 billion with a B subsidy essentially on soybeans that will make its way into the farm program system, which is kind of what happened back in the last time that we had some tariffs raise their head in 2018. So I do think that there'll be some version of it. I don't know if it'll get down to, it's going to be a rebate on some things and not others. Initially we weren't too worried about farm equipment because it kind of qualified in that USMCA exemption. So we weren't too worried about it until the whole thing came out on, no, if it's got aluminum in it, we're going to tariff the heck out of aluminum. So I do think there probably will be some rebates at some point. With that said, we might also be in a new era of taxability that just says we might have to get used to tariffs in exchange for our income taxes being a little bit lower. I don't know if that's permanent, but that's something that none of us have really thought about in the past. We just hear tariff, and that's a kind of a new tax. We don't like that. But knowing that might be paying for estate taxes going away, or that might be paying for our income taxes being capped at 35% and never going back up over 40, that might be an okay thing. And frankly, that's something we probably all just got to figure out over the next few years of, do we like tariffs better than income taxes?
All right. And then is it possible to get an exemption for the tariff for ag equipment?
Like I said, most of it, the ag equipment itself kind of follows under that USMCA stuff and we shouldn't be seeing a lot of tariffs. It's the components that are getting us right now. And so that's out of my wheelhouse as far as knowing if there's an exemption to apply for yet. I don't think there's anything like that to apply for yet, but I would not be surprised if something like that comes up, because one of the things that we learn about the tax bill, to get the government back open in times like these, we got certain factions vying for things that other factions don't want. And we got some people buying off, so to speak, those factions to get things that they want. That's probably how the government gets back open, right? Is that there'll be stuff like, oh, well, let's put an exemption out there for tariffs on such and such, and that'll win over Senator so-and-so. And that's probably what will happen. Unfortunately, I don't like that, but that's probably how those exemptions will come up.
All right. And this is just a comment, not a question, but solid point about considering tariffs as taxes and advising dealers to look at them that way. They're a one-time sunk cost and will not be reflected in the future value of the machines.
Yes, I would agree. I think that's something, if your accountant doesn't talk to you in creative terms about stuff like that, you probably ought to talk to him. I don't know, frankly, how I'm going to come down on it right now. It's new to us too. But I think as we wade through that, that comment is very correct. It doesn't feel like something that's a capitalization expense, right? It feels like something government said I had to pay it. So.
All right. Another question related to the tariff piece. Do gray market tractors coming from Europe as late model used tractors get hit with the tariff?
I can follow up on that question. I don't know the answer to that. In theory, it feels like not, because it's not new. That second market. So it doesn't feel like that is there, but it's not my expertise. So I'm talking off the cuff, which is dangerous.
All right. Give it another minute or two.
Well, as you're waiting for that, Kim, I would say certainly if anybody's got any questions, they can reach out to me. We've got tax experts that are way above my head on this one as well. I deal with just my dealerships, and we've got people that can deal with that, and I'd be glad to answer any questions. The other thing I might address is just, I do think for the most part, If I didn't say it clear enough in this, I think that there is an impetus for customers of yours to buy equipment this year because of this bill, whether it's the tax deduction or whether it's the $66 billion that's going to go out as farm program payments. It does feel like I'm hoping that farmers are going to check their bank accounts and talk to their accountants in October and November and realize that this year was actually a better year than they thought it was, because they got some of that $33 billion back in April. They're going to get some of this $66 billion now. They have soybeans. They're going to get some of that $10 billion. They've got cattle. They're still making good money. I have a suspicion that farmers are going to do their late year-end tax planning, talk to their accountant like they used to me here in Kansas, and their accountant's going to say, hey, you made $300,000 this year, whether you thought you did or not. You need to go buy a piece of equipment, and they will. So I think this might be one of those years that we see a late run on equipment again, in that October to December timeframe as farmers get their tax planning done. That's my hope.
We did get a couple questions in. One is a comment. So I think this is related to the gray market question. Just someone sharing that they think it falls under the components for tariffs. So, but we'll stand by the.
We'll follow up.
We're not positive. Then the question that came through: are you suggesting that dealers should have a line item on their customer invoice that is labeled tariff fee or something like that?
To me, that makes the most sense. It's kind of like first off, it's a charge that you don't have any control over. So as when we had high gas prices, we put fuel surcharges on there. When we had a lot of new computer stuff that we had to buy, we put technology surcharges on stuff. This is a tax surcharge, as a tariff, right? And to me, the more detailed, the more transparent you can be in there, the less trouble you get in for saying, hey, that last $15,000, that wasn't on me as a dealer. Either I had to eat it or you had to eat it. And I'm already operating at thin margins. You already got a deal on the equipment. I couldn't give that away to you too. And then plus it gives you that way to come back and say, in 2 years from now, when they trade it in, you can look back and say, okay, the cost of that equipment was $150, not $170. $20,000 of that was tariff. That's not value. That's no different than sales tax. That's on you. So yes, I would suggest that.
All right. Well, with that, we will wrap things up. Thank you again, everyone, for joining us for today's webinar. Like I mentioned earlier, we will have a replay of the webinar available up on the Farm Equipment website in case you want to go back and review it or share it with anyone else. We should have that ready within the next 48 hours. On behalf of Mark and the Pinion team, as well as the entire Farm Equipment staff, thanks for joining us. Feel free to reach out if you have any suggestions for topics you'd like to see us cover in the future. And with that, enjoy the rest of your day, everyone.